This presentation discusses two special considerations when projecting loss of earning capacity for oil and gas workers in personal injury. First, because the price and demand for domestic oil and gas are volatile, employment and earnings of workers in these industries are also volatile and require adjustments for cyclical booms and busts. Second, because short, medium, and long-term factors make it improbable an uninjured worker in the oil and gas industries would remain working in those industries for their entire work life, it is necessary to consider an alternative scenario based on the worker's earning capacity in other industries. Adjustments to base earnings and wage growth. A vocational consultant or economist should make adjustments in projecting pre-injury future earnings for an oil and gas industry worker. In personal injury cases, lost earning capacity is calculated as the difference between a pre-injury scenario, what a worker could have earned before the injury, and a post-injury scenario, what the worker can earn after the injury. When workers have a stable work history, we often assume their past earnings represent future earning capacity for the pre-injury scenario. For example, a worker who earns $45,000 as a factory worker before an injury could expect to continue earning at least $45,000 per year had they not been injured. Earnings in the oil and gas extraction industry and related support industries are less stable than in other industries. For these workers, past earnings must be adjusted for cyclical volatility. RPC adjusts earnings and wage growth rates for three categories of oil and gas workers: oil and gas extraction, drilling oil and gas wells, support activities for oil and gas operations. Oil and gas extraction, NAICS Code Group 211. Industries in this subsector operate and/or develop oil and gas field properties. Activities may include exploring for crude petroleum and natural gas, drilling, and all other activities before the product leaves the producing property. This subsector includes production of crude petroleum, mining and extraction of oil from oil shale and oil sands, and production of natural gas. Drilling oil and gas wells, NAICS Industries 213111. Industries in this subsector primarily drill oil and gas wells for others on a contract or fee basis. This industry includes contractors that specialize in spudding, drilling, re-drilling, and directional drilling. Support activities for oil and gas operations, NAICS Industries 213112. Industries in this subsector primarily perform support activities for oil and gas operations, except site preparation and related construction activities. Services include exploration, except geophysical surveying and mapping, excavating slush pits and cellars, well surveying, running, cutting, and pulling casings, tubes and rods, cementing or shooting wells, perforating well casings, acidizing and chemically treating wells, and cleaning out, baling, and swabbing wells. Because of earnings instability, an economist or vocational consultant will smooth out the effects of industry volatility by averaging earnings over 10 or more years. Before averaging, the analyst should convert earnings in past years to current dollars. If a worker has earnings from the oil and natural gas industry for 10 or more years, the analyst can average the worker's earnings. If the worker has earnings from fewer than 10 years, the analyst can compare the worker's earnings with median national earnings for the same years. This formula compares a worker's earnings for the industry over more years, smoothing out volatility. The example is from 2000 through 2019. This graph shows the median earnings of oil and natural gas extraction workers from 1972 to 2019. Since 1972, the nominal wages of oil and gas extraction employees have grown 2.89% annually, Annual CPI inflation from 1972 to the end of 2019 averaged 1.30%. The real earnings growth rate for these workers is the difference between these values, or 1.59% annually. If an economist bases future wage growth on past wage growth from a shorter period, the resulting projection may be unreasonably high or low because of the boom or bust cycle of oil and gas worker earnings. Here are examples of wage growth calculations done incorrectly. Using a too low growth rate based on one 10-year period understates total earnings by over $48,000. Using a too high growth rate based on a different 10-year period overstates total earnings by more than $88,000. Considering an alternative job scenario based on the worker's earning capacity. A vocational consultant or economist should consider employment in other industries because it is improbable workers can remain in an oil and gas job for the remainder of their work life. Besides adjusting for instability when analyzing oil and gas workers' wages, the analyst must consider how the number of oil and gas jobs will change due to changes in extraction technology and global demand. Is it reasonably probable those jobs will exist for the rest of the injured worker's work life? The Bureau of Labor Statistics, BLS, began tracking employment in the oil and gas extraction in 1972, when the industry employed about 140,000 people. OPEC embargoes in 1973 and 1979 raised oil and gas prices, leading to peak employment of about 270,000 jobs in the early 1980s. After 1982, employment fell steadily to 125,000 jobs in 2000. After 2000, hydraulic fracturing or fracking caused an increase to 200,000 jobs until late 2014. In late 2014, oil prices, the number of active drilling rigs, and the number of jobs began dropping sharply. Since 2017, oil and gas extraction has been between 140,000 and 155,000 jobs. In 1990, the BLS began tracking workers in support activities for oil and gas operations. There were about 110,000 workers in support occupations. This number was roughly constant until the fracking boom in the early 2000s, when employment skyrocketed, surpassing the number of workers in oil and gas extraction. At the peak in December of 2014, there were over 334,000 workers in support jobs. Since 2014, the number of workers in support activities has fallen below 200,000. 4 factors currently affect the short, medium, and long-term outlook for jobs in the oil and gas industry. Factor 1. COVID-19. COVID-19 sharply reduced demand for oil as consumers drove less and airlines reduced flights. Prices dropped and it became unprofitable to drill new wells. The number of jobs fell. Factor 2. Russia and Saudi Arabia's manipulation of oil prices. Russia and Saudi Arabia flooded the market with oil. Oil prices fell to historic lows, further reducing oil and gas industry jobs. Major extraction and support firms filed for bankruptcy, including Noble Corporation, Chesapeake Energy, Ultra Petroleum, and Whiting Petroleum. Factor 3. Automation. The oil and gas industries are becoming more automated. Remote monitoring and remotely controlled drilling require fewer workers. Eric Carey, an executive with Halliburton. Some traditional roles in the oil patch, particularly manual field operational and manufacturing jobs, will gradually disappear. A lot of jobs won't exist. The effects of automation will continue to be felt for the next 20 years. Factor 4. Firm consolidation. The fracking boom and the rise of natural gas as a cleaner alternative to coal created many new firms in the concentrated oil and gas industry before 2019. In 2019 and early 2020, there were several mega deals in the oil and gas industry, but the overall deal count remained low. Analysts expect the oil price collapse to increase concentration as larger firms absorb smaller competitors. Bankruptcies in the industry will also increase consolidation. As firms consolidate, they reduce overall employment. In October 2019, there were 426,000 workers in oil and gas extraction and support jobs. By May 2020, the last month with complete data, employment fell almost 20% to under 350,000 jobs. The decline began before COVID-19. After May of 2020, several companies announced large layoffs and many others declared bankruptcy. Carr Ingham, a petroleum economist with the Texas Alliance of Energy Producers, projected the loss of another 12,000 jobs in Texas alone after June of 2020. Ingham said, "It's difficult to imagine that oil and gas employment and the rig count will ever be as high as it was." Many analysts expect any rebound in jobs post-pandemic will be gradual and incomplete. Meanwhile, structural shifts due to automation and consolidation will eventually reverse any medium-term job gains. Long-term, industry consolidation and automation will reduce jobs in oil and gas extraction and support. A joint research endeavor of the Canadian government, Ernst & Young, and Petrol LMI projected the effects of automation on the oil and gas workforce through 2040. The report made findings for 124 specific oil and gas jobs. The authors estimated that between 48 and 76% of drilling jobs could be lost to automation by 2040. Between 59 and 67% of equipment operator jobs and between 55 and 68% of trades jobs could also be lost. The opinions of vocational and economic experts must be reasonably probable, that is, more likely than not to occur. For pre-injury jobs, frequent opinion is the worker could have continued in a job for the balance of their work life. For jobs in the oil and gas industry, it is no longer reasonably probable a worker could continue that job for the short, medium, or long term. In the short term, the job's outlook is negative. From October 2019 to May 2020, almost 20% of jobs were eliminated. Since May 2020, further reductions have been announced, and analysts project more to come. For unemployed oil and gas workers, it is no longer reasonably probable they will find new jobs in the oil and gas industry. For workers injured before October 2019, it is unclear if they would still be employed in their pre-injury jobs, absent any injury. Over the medium term, companies may be slow to reactivate wells or add jobs. Employment numbers will likely increase slowly but not reach 2019 levels. Over the long term, about 60% of oil and gas jobs could be lost to automation. Therefore, it is not reasonably probable, more likely than not, a worker could continue to be employed in an oil-filled job through 2040, absent any injury. An earning capacity scenario should consider jobs outside of the oil and gas industry, based on education or another industry the workers have held jobs in. Because of the probability, a person could not be employed in the oil and gas industry their entire work life. A vocational consultant should consider earning capacity in other industries. Pre-injury physical and cognitive abilities and limitations from clinicians. Vocational tests of aptitudes and interests. Transferable skills analysis. Potential for additional education or training. Labor market survey. To conclude, there are two adjustments to consider when calculating pre- and post-injury earning capacity for workers in the oil and natural gas industry. Adjust wage and wage growth for booms and busts. Oil worker annual earnings should be adjusted to account for the cyclical nature of earnings in the industry. Oil worker wage growth rates should be based on long-term trends rather than short-term fluctuations. Consider earning capacity in other industries. It is no longer reasonably probable workers can hold oil and gas jobs for their entire work lives. There should be two pre-injury job scenarios, one with an oil and gas industry job and one with a job in another industry, based on a worker's personal history. RPC has many experienced expert witnesses. You can find more information on our staff and services on our website at www.rpcconsulting.com. Author Brian Piper, Ph.D. Dr. Piper is an economist with RPC. He specializes in quantitative analysis and modeling, and he works on a variety of cases, including personal injury and commercial litigation.